listings lined up in a row. Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. Down, the numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Happy Wednesday. Welcome to the Educated Homebuyer Live with Mr. Josh Lewis and myself, here to educate you, guide you through the home buying process, answer your questions, have some fun. Josh, happy Wednesday.
It's a very happy Wednesday. We're already there. It's only one work day or two work days into the week, and we're done.
Is the color off on my camera? It is.
You
right?
look green and I look red or orange. So I'm an Oompa Loompa and you're like an Oompa Loompa's pants. I don't know why.
Something's not right here. So yeah, I gotta figure this out. All right. Well, you keep talking. Talk for a minute here.
I thought maybe you put a filter on that just made yourself look prettier.
Yeah.
Well, I can't filibuster. What do we got here? Well, what I was going to say to Jeb, but while Jeb is fixing that, he can't really comment, is that in one of the slides I'm going to show you, we have the jobs report coming up on Friday. And I just learned, I should have already known this, but Polymarket does odds on this. And if you're outside of the United States and France, you can bet on what's going to happen. And strangely, they have some really odd numbers. 35,000 jobs were created last month. And we'll talk about this a little bit more. But they have the lowest group, Jeb, in Polymarket. There you go. You look normal, but you're on the wrong side now. Yeah,
there we go. We're good now. We're good.
You can't be on my right. You're on my left. So what I was saying, Jeb, is Polymarket has odds on all sorts of things that if you're not in the US or France, you can bet on. And they have how many jobs added in August. And the lowest group they have is under 50,000. We had 35,000 last month. So you would have to think it's going to improve a bunch to get out of that. So I wanted to bet, but I would have to get a VPN or fly across the ocean or something to be able to wager on it.
And we're talking about the jobs numbers, I presume. Here.
Yes, sir.
All right. There we go. Okay. I'm in the know. I know what's going on here. See, I told Josh, I asked Josh earlier this week, I said, am I crazy to think that the jobs numbers are going to come in higher than what most people expect, since our president, President Trump, fired the Labor Bureau, president or whatever her title was, last month after the numbers came in weaker than expected. And I get it. It's a reflection of him if people are losing jobs, but he wants lower rates. So it's kind of one and the same. So he wants his cake. He wants to eat it too. And so
a really hot labor market with really low interest rates, two things that are kind of at odds with one another.
Yeah. So I don't know. I think we need this good cop, bad cop thing, Josh. I'm going to say that the numbers are going to come in stronger just for sake of argument here, and it's going to reverse course, and everything's
My
gonna
response to you when
tailspin.
you suggested that is the Bureau of Labor Statistics. We see a number that the talking heads on TV say, oh, unemployment's up to 4.2, it's down to 4.1. But if you go out to the BLS website, there are reams and reams and reams of data for you to dig into that they have published for decades. So could the numbers be cooked? Could they put their
It's
thumb on
not
the
cooking
scale
them.
and tweak that?
It's not cooking them. It's changing the way that
You can't change the methodology in 1 month and come out and say, here's your new numbers. Oh, by the way, we changed the
Trump. Hey,
methodology.
bro, you talking to the
Hey.
wrong president if you don't think that can
That's
happen.
the way your president does it. My
Yeah.
president does not do
makes
it
the
that
numbers
way.
appear how he wants them to appear. So, and no, in all reality, again, I think, like you said, I mean, the trend looks for interest rates to continue moving down. I think that's the thing. Tonight's episodes don't expect interest rates to fall much more in 2025, and that's coming from Fannie Mae. Fannie Mae just republished their numbers for the remainder of the year, and they're actually up a tick from where they were. I think they initially were thinking 6.4. Now they're thinking 6.5. And they're thinking you don't see a real move in mortgage rates until 2026. But even then, they're only expecting rates to be in the low 6% range, around 6% by the end of 2026. So, could they be right? Sure. But at the moment, the data is pointing to, softer economy, which in turn could allow things to move a little bit quicker. That said.
We'll go through it. We have slides. We
We do. And we always like to start by going through those. So while we're doing that this evening, Josh, we've asked some random things of the people in the past. We've asked them where they're from, completely random. We've asked them whether they liked fantasy football. Nobody even liked that question, so they didn't respond. So tonight, let's ask them something different. What do you have in mind?
Are you happy with the fantasy football team you drafted? Is that
No, we're not talking fantasy football.
Okay.
It's garbage.
Well, we got a big game tomorrow night. Eagles and Cowboys, and the Cowboys are giving away their best players for pennies on the dollar. So who
Is that even a game?
who will win tomorrow night? Cowboys or Eagles in the
Dude, if anybody says the Cowboys, they're just a lifelong Cowboys fan.
And there are many of them. It's America's team.
There are.
It's America's
and they
team,
are
Jeff.
still hanging on. I don't know how, but they're there. Anyhow, let's move on. So like to always start by taking a look at the charts, and here we are. So we always like to start by my computer not working is the way we like to start.
Do you want to go back to number one? I can take it back for you.
No, there we go. I just want to go here and make it bigger on my side so I can actually see it. All right. So here's what we're going to do, Josh.
We're going to use
Inventory.
all of the super
Inventory.
chat money to get you a bigger extra monitor so that you can see this while you're doing this.
That would be nice. It would be better if I filmed this here and not here because there's nothing here. I'm just staring at a small camera. But anyhow, inventory actually dropped this week, went from 861,000 homes to 860,000 homes. And this data doesn't actually reflect the Labor Day stats in it quite yet, I don't believe. So chances are the talking heads, the people in the know, seem to think that the inventory is likely peaked for the year, unless we see a sizable move down in rates. But at the moment, we're 22% over where we were last year with regard to inventory. This chart, similar chart, just the only difference here is there are more years added in. I like this chart because you can see 2019, you can see 2018. And what those markets look like, because those were more normal years in the housing market, but both higher than where we sit today. But anyhow, just for context there, you got a couple more years to work with on the inventory front. Huntington Beach and Orange County. So charts might look a little bit different this week. That's because
GPT changed its mind.
And me are not friends anymore. And they decided to change my data and do different things with it. But we are sitting at 4,821 homes here in Orange County, 291 in Huntington Beach. Again, the thought for Orange County is that the peak is likely in. I think, hit the high sometime at the end of July with regard to inventory, maybe even early August, and that the numbers are going to continue to trend down as we move into that fall-autumn market, which essentially is where we're at the moment. Now, once you get past Labor Day, we're kind of in that slowing season, and things really start to pick up really in the last 2 months of the year, once you get closer to Thanksgiving and Christmas. And that's when you see that inventory drop off, as you can see from the previous 2 years that we've been aggregating this data in the charts there below. New listings, new listings. So here's the thing. So I'm just going to read a couple things. So seller activity remains slightly ahead of last year's pace. This week, there were 63,761 new listings compared to roughly 60,000 last year. For the past 3 years, we've seen seller activity rise during the first few weeks of September before the seasonal decline sets in. The issue is we saw a decent size decline this past week, and we know this upcoming week will have Labor Day in. So basically not very optimistic as to where listings are going to come from going forward. So you're likely going to continue to see inventory decline. I'm talking to buyers right now saying, hey, listen, if you're out there in the market and you're seeing less and less property, it's not you. It's just the market. It's normal. It's seasonal. It's something that we see every time this year. Doesn't mean you can't find the right house and new listings can't pop up. It's just that you're not going to see what we've seen over the last couple of years. Weekly pending sales, total pending sales, much the same. Not going to dive into this stuff. Numbers are still trending down, still above where we were last year. Percent of properties with price reduction sitting at 42%. We're seeing inventory come off the market now a little bit because of the seasonal time of year. We're also seeing, interest rates come down a little bit. So my guess is we're probably getting close to that peak in where we're going to see price cuts this year at 42%. And so there's a high likelihood that kind of moves sideways, potentially even down as we move into the latter part of 2025. Mr. Josh Lewis, when we talk about median price per square foot, it's not something I reference a lot, but it is something that I do pay attention to. And some of the numbers are just crazy in some of these markets.
So you can do anything with data. We've talked about on the show, Jeb, a million times that median data it can be skewed and it can not tell the story. Price per square foot is not the greatest metric. Like using my neighborhood for an example, we have the smallest home in the neighborhood, and the people with the biggest ones on the price per square foot, they go, "That's bonkers what your little houses sell for." And you're like, dude, we have the same lot, and the lot is largely the reason for the value. I could throw a second floor on my house. So it's not to say that this is the be all end all data, but people are trying to tell you about the weakness in the housing market. And this story tells you the green is the list price, the red is the sale price. There was a dip down here when we're looking up at that top right. You can see a dip, but it is corrected and going back up. And some of that I would attribute to the slightly improved affordability with lower interest rates. And we'll see what continues to happen if and when they do continue to trend lower. On the negative side, one of the things that people are pointing to is, hey, consumers are not doing as good as we get. We get these mixed pictures, mixed signals from the data that's coming out. This is an interesting one. This is change in monthly consumer real spending, and this goes back for the quarter century from 2000 to 2025. Now, how about that, Jeb? That's wild. A quarter century back to 2000. So
stop it.
Yeah, that's wild, that number. But when you look at that, there's really only three numbers there that stick out at the bottom: 2008 and 2009. 2008 was negative for most of the year, slightly positive. 2009 was negative. So consumers spending less money, and this is real consumer spending. So after adjusting for inflation, we're spending less. And you see that blue line, it's still positive, but much lower than what you've seen. That has been historically a signal that a recession is coming. The Wall Street Journal ran an article in the last few days about what is going on with the consumer. We see this, unfortunately, Jeb, in the comment section on YouTube. We have a lot of Debbie Downers that want to tell us that the world is about ready to fall off of a cliff, despite the economic data not telling us that. And this is actual versus predicted consumer sentiment. Somewhere during COVID, they diverged, and actual consumer sentiment is much lower than predicted by. And what is it predicted by? Is it someone sitting there in Karnak the Magnificent pulling out the envelope and going, "This is what I expect"? No, it's an aggregate of data that has been tightly correlated with consumer sentiment. So this is interesting. They followed up with another piece of data here. The percentage of people that agree or disagree with the statement, "People like me have a good chance of improving our standard of living." And you look, the divide there, that gap over there to the right is, again, 2020, that dropped. And it's almost flipped completely from 75-25 that say they agree to 75-25 that say they disagree. Jeb, you talk a lot about here on the show, control what you can control. One of the things you can control is your attitude. And if you're one of those folks in the gray, even if things aren't looking good, if there are true facts that you need to acknowledge, some headwinds that you're facing, that approach is not going to lead individuals or us as a country in the right direction. So, Jeb, it's Jobs Week, but Jobs Week with a holiday. So we're kind of pushed back
We're
a
off
day
a day,
on
yep.
everything. So JOLTS should have been yesterday. It was this morning. The 7.18 million job openings is interesting, but the chart is worth, picture's worth 1,000 words. You can see that we went from 2022, 12 million job openings down to 7 million. That's despite the fact that some of these job openings are double counted in the era of posting them online. This is how the market reacted this morning to that. The JOLTS data took us from about 425 down to 422. It's only 3 basis points, but it basically is traders saying, hey, that's not great. We also started the morning around 428 and it dropped to about 425 based off of Fed comments, primarily Waller, and we're going to look at that here in a second. But this is a little deeper dive into the data there between hires, quits, and layoffs. So the hiring rate is the important one to look at. It's been slowly trending down, but if you look at the right side, it's definitely had an inflection down in the last couple of months. We're either going to look back in 6 months and say, hey, that was an inflection point to a much weaker economy, or we're going to look at it like you can look back at different points on that line and go, that was noise at a certain point in time. The quits rate, the layoff rate have been very stable. It's not really telling much of a story there. Waller, who was interviewed on CNBC today, and these are direct quotes, we should cut at the next meeting. We don't need to go in lock sequence of rate cuts, meaning like 100 basis points over 3 consecutive meetings last year. He's saying they don't need to do that. We could see multiple cuts, whether it's every meeting or every other meeting. We'll need to see what the data says. We know we're going to have a blip of inflation, and we're going to look at that in a second, but it won't be permanent. 6 months out, we'll be closer to 2%. We can always adjust the rate cut pace as we go. On inflation, we're on Trueflation, we're down over the last week from 2.12 to 2.02. So definitely is kind of telling a story that we're trending up and ticking up in terms of inflation, but still not becoming real problematic, at least in the way Trueflation measures it. This is the Cleveland Fed's nowcast. If you look at all this, and if we look, we've been tracking this for about 2 years. They do a really good job. They are pretty dead on with their numbers. I don't know that we've got a surprise in the last 2 years from them. So the top chart shows the month over month and what they expect for August and September and what that would play out in the year over year figures. And almost all of those are up at 2.75 to 3% range. And if we look at the quarterly figure, so it tells you when you see changes looking at the last 90 days, what that annualizes at, all of those also at 3%. So the Fed has this conundrum that we are definitely seeing a weakening job market. Is it weak? Is it soft? Probably not just yet, but it could be depending on how Trump delivers the data on Friday. But we're definitely seeing inflation trend up because of largely the tariffs. This is the chart I was telling you about earlier, Jeb. Let me get back over here because the consensus forecast with Trading Economics, they put a consensus out of 75,000 jobs. So you can get some real good numbers here on sub 50,000 when we're coming off of a report last month of 35,000 jobs. Goldman Sachs is one of the more bearish ones. They're expecting about 60,000 jobs. So a report that you follow, another lender puts out, Jeb, every Wednesday, said we're 1 week jobs report shy of seeing rates at 6.125. And it's hard to disagree with that, but it would need to be sharply weak. If we get something much below 35,000, if we get something with a negative print on Friday, you will see rates drop rather quickly. So the market's not expecting that. It's actually thinking that the jobs report will be a little stronger than last month, but we will soon see. Again, looking at the same stuff we looked at a few weeks ago, we have a pennant forming. We're well within that, but even within inside of that, the 2 purple lines there, it's really a narrow range between 4.2 and 4.33. So while we can see here that rates are at their best levels, they're up slightly year over year. Jeb, I hadn't realized that, but then I looked at the calendar, and last September and October was when rates were really at their best levels, and we were doing a ton of refis. So it makes sense there, but you see lots of green across that chart, meaning that over the last 1 day, 1 week, 1 month, 1 year, we're seeing the best level of interest rates, even though they're well above what people have got accustomed to over the last 15 years. Just about 6.5 on the 30-year fixed, FHA and VA right at 6%. And I wanted to throw this out there because Matt Graham at Mortgage News Daily, who puts this index together, actually pointed this out in one of his market ending videos last week. He said, remember for this, that is the highest tier of credit, 780 or above, and that is 25% or more down. The majority of you listening here, many of you do have 780 and above, but we have a lot of 740. We have a lot of 690, and you're going to pay a little bit more than this. And most of our people are doing 3% down, 5% down, 10% down. So you should get close to this. And if you are in that best tier, you're probably going to do a little bit better than this. But don't look at this as saying, oh, anyone trying to charge me more than that is cheating me, because also this generally includes some level of points versus a 0-point interest rate.
All right, good stuff. And with that said, if you're looking to talk to Josh, go through the pre-approval process. You have a quote, looking to get a second opinion, you can get there going to jebsmith.net/start. And if you have, an interest rate you're trying to refinance at some point in the future, jebsmith.net/rate watch. We'll get you on our rate watch list. We can, watch rates for you, reach out as they start to decline so that you don't have to pay attention to it. With that, Mr. Lewis, not really a lot of questions. We've got some people rooting for the Eagles. It seems to be that the Eagles are the only option here, which smart people.
Did we ask if they're rooting for the Eagles or if they just believe that
it doesn't really matter if you're rooting for them or not. The Cowboys, I'm not sure, have
the Cowboys are not going to win.
No, they're not going to win. And I say that, and they'll, that somehow they'll miraculously pull it off. But I'm just an anti-Cowboys fan. That's pretty much the reason that I root against them every time. But anyhow, let's answer some questions here. We've got just kind of a comment followed, by something we could talk about here, Josh. So we got Jay Castle, having a heck of a time finding a home in the 400s. Are starter homes realistic anymore? It doesn't seem like it. Located in Sacramento, California. So I have a client or a friend actually that I just referred up to an agent in Sacramento, one we've done a lot of business with over the years. And she listed his home, and I think it was in the 6-something range, 650, 675. Nice property. It sold in like 3 days, multiple offer situation quickly. Our another listener friend Jensen had his house up there. I think his was like 550, and he was having a hard time selling it just a couple months ago. So,
and it was really nice when they bought it. It was a flip, and he said there's some typical flippy stuff there, but like nice kitchen, nice bath, looks great in pictures.
Yeah. So and neither of these are super large homes. So when you start talking about the $400,000 price point, like, I don't know what that gets you in Sacramento. I don't know if you can get a single family home for 400,000. I mean, I'm assuming you can get a townhome and a condo. Yeah.
Zillow as of June said the median sale price for Sacramento was $471,750. Median list price of $495. So 400 is about 20% below that. So it's a good bit below that.
Sure. Yeah. I mean, single family might be tough. Condo, townhome, probably a little bit more realistic. Hard to say. What I would say is, if you don't have a good agent up there, find somebody that knows the area, has opportunity to listings and other agents that know properties coming up and network and try to find something that may be coming to the market, because you need a good agent in that market, regardless of what's happening up there. But things still seem to be moving. But if you need somebody, that link below will get you in touch with me, and I can get you in touch with the team up there that is helping a lot of people.
I want to piggyback off of that answer, because something that's come up just in the last day or so with a buyer here in Los Angeles County, I think is instructive here. If you go to Google, if you Google Zillow, Redfin, just use your favorite GPT and have it say, what is the median home price, both sale price and listing price, in the area that I'm looking at buying? And if your price point is south of that, in most markets, so your mileage may vary. In most markets, that's going to be a tough price point. Jeb, you just put out some of the info from Steve Thomas, a past guest that we had, and the toughest price points throughout Orange County are the lower price points.
Sure.
The lower you go, if you go below median, there are a lot of people wanting to get into the market.
Yes. I mean, think about it, right? More people can afford at that price point, right? And therefore more demand. And it's all of those things that you think about. It's, people are like, the lower price point, nobody wants them. No, there's a lot of people that want them. Therefore, competition is high. And a lot of times they sell quickly. over the asking price, that sort of thing, just because of the actual demand on it. Platinum Black has a good question. Says, what are the chances we'll see another Fed rate cut causing mortgage rates to go up? So last year, Josh, we had the Fed cut 50 basis points. And then all of a sudden, shortly after that, we actually saw interest rates start to go up. What's the chances of that? Or why did we see that last year, I guess, is the better question.
So the market front ran that a lot. The market started seeing some weakening in the data, and before the Fed did anything, had already taken the 10-year treasury from high fours down into the low, or not the low, the high threes, like 100 basis point, 125 basis point move. I would have to look at the chart to tell you exactly what it was. And about the time that they started cutting is when we started seeing a little inflection point in that data, and it was showing some inflation starting to tick back up. Jobs data, really, really strong. Jobs data that was later revised to show that it wasn't that strong. So if you look historically, that is not common. You can see a knee-jerk reaction when the cuts first come, that rates bump up a little bit, and they will generally then continue trending down. So could it happen? Yeah, but it would be, are we just way off on where the economy is right now? And we've talked about this week after week after week, mixed signals. We think absent the tariff inputs that inflation would be well on its way to 2% and treasury yields would be much lower. We've seen the political environment leading to both less labor demand and less labor supply. So the unemployment rate has been really stable, but that's not showing a very strong jobs market, even though we're at historically low levels. It means that we have less workers and there are less jobs available for them. So again, very cloudy outlook. So could it happen? It absolutely could happen. Is it likely to happen? Pretty unlikely, as the market has performed this year in a much more orderly way with a very slow, deliberate downtrend in interest rates versus just this firing down all at once.
All right, good stuff. A couple people just jumped in. Rob says new builds in Sac are in the 400K range, so maybe new construction could be an option there. Probably some incentives going along with that. We even have,
but Jeb, remember with that, you're probably going to have an HOA and you're probably going to have higher taxes. So a lot of that mitigates the difference between 4 and 450 with no HOA and standard taxes versus Melrose and special assessments. You got to look at the whole picture, but the subsidized interest rates do go a long, long way.
Yeah, no, and good points that Josh made there, but definitely something to look into, especially with some of the incentives that are going on. I mean, I don't know when the fiscal year end of some of these builders are, but again, builders aren't in the business of holding on to property. So, there's certain timelines that they're trying to reach, certain incentives they're willing to do, and things that, they want to make happen in order to get a sell. So, but go in with a real estate agent, someone that can negotiate on your behalf and help you out. Wesley, the slacker, who was called out earlier in the chat by Dixie, is here.
We have a rumble with Dixieland and
Wesley. I in no world is Sacramento better than SoCal. Just so we're clear, just
not in any way.
Even if you believe that, it's not true. Just,
do you know how many spectacular drives there are in different parts of the state of California? And then there's that stretch of the 5 for like 3.5 hours through Sacramento and the wasteland when you're just wanting to be anywhere else.
True. Sacramento's a lot closer to some nice visual sites, but Sacramento itself is.
I understand the appeal of Sacramento, and I wouldn't tell anyone not to do it. I mean, hey, listen, isn't it a top like 40 metro in the U.S.? It is a big area. They've got professional sports teams. You're close to the Bay Area if you want to run over and have fine dining or go to a concert. There's a lot good about it, but it's visually not the prettiest.
I'm going to read a comment, Josh, and I just want you to tell me what comes to your mind as I read it. Okay. All right. If I find it. If a home sold in 2022 for $530,000, now they want $610,000. House has been on the market for 100 days. What's a good offer?
Ooh, and I believe he also follows up here. He has another really good question, but he says Murrieta, California. So it's a very nice market, a nice suburban SoCal, lots of demand there. The affordability is much, much better than many parts of Southern California. So 530 to 610 over the last 3 years is 20%. So you're talking 5, 6, 7% appreciation. It's more than what we've seen in the market. But I always like to point out, people get hung up on what someone paid for something. If that person made the buy of the century and the home should have been 600,000 when they bought it for 530, it's irrelevant to you buying the home. But looking at that 610, the market is saying, hey, that's overly aggressive. So from there, I don't know that there's a wrong answer. It's more than 530 most likely, but south of 610. Is that a waffling answer? Is that a politician's answer, Jeb?
I mean, you said part of what I would want to say, and it's that what someone paid has no bearing on what you should offer for a property. Zero. You should offer based on what comparable sales in the neighborhood are selling for, and then base your decision off that, right? If, again, like Josh said, when they paid 530 for it, maybe they got a deal. Maybe they overpaid. You don't really know. Markets like Murrieta, some of those markets have like stabilized, less crazy than they were obviously in 2022, but even less crazy than, 6 months ago. So prices have settled down a little bit there. But what I would try to do is go try to find homes that have sold recently, similar bedrooms, bathroom counts, see what, the numbers come in at. And that way you have a basis for the number that you're offering. So you're not just making up some number in your head and thinking, hey, this is what I'm going to offer. I mean, you could do that, but any good agent on the other side is going to come back to you with the comparables and say, hey, listen, this is where we're getting the number. And, this is why we're at the price we're at. So again, just do the research, and go from there.
Jeb, the question brings to mind, I was going through and replying to a bunch of comments on the podcast YouTube channel today, and 3 different people had mentioned the market is where it is because of these greedy sellers. They ask too much for their homes. They say most sellers want to sell their home. The market dictates what they can sell it for. So if they're a serious seller and want to sell their home, they need to figure out what the market is and price it appropriately. I told one of these commenters is, I am greedy. I will tell you I'm greedy. I would like to sell my house for $10 million. If I put a sign out in the yard that says this greedy guy would like to sell this house for $10 million, I'm going to get lots of snickers from my neighbors and 0 offers for my home. Greed has nothing to do with it. If you owned a home, you would be greedy too. You would want to sell it.
It's not greed.
You would want to sell it for as much as the market will bear. That's what every seller does. There's a buyer on the other side saying, I will do it, so this is what the market will bear. So if your brain is telling you that greed enters into the equation in what homes sell for and why home prices are high, you are high. And the reality is, like, every seller wants to sell their home for as much as possible. No one, the flip side of greed, was it charity? When you become a homeowner, are you going to go, hey, you know what? I bought my home and I got a good deal and I've lived here for 10 years. The market says it's worth 610, but I would like to let it go for 5 because I'm very charitable. You're not that person. So don't call the seller that also wants to sell their home for a market price greedy. But in this situation, that 610 not selling for 100 days, maybe they are greedy and the market's telling them that.
Yeah, but also understand maybe that property was under contract. Maybe it was under contract for a price that was higher than that, and now they've since lowered that price to that number, and it's been sitting on the market for 100 days. You have to understand the whole story, right? Just because you see something on the market at a price for a certain period of time doesn't mean it's always been at that price, doesn't mean they haven't been under contract, doesn't mean it didn't fall out. There's so many different variables there, and that's why you need an agent to guide you through the process, answer the questions, get the information so that you can make informed decisions. Josh, you seem to be on a pedestal right now and raging a little bit. So what are your thoughts on getting rid of property taxes entirely?
Where the money that property taxes pay for services, schools, roads, firehouses, police, are we going to defund them? Are we going to say GPT?
No, we're going
my children?
Our state tax is going to go up to 50%. That's what's going to happen.
Yeah. So realize that it has to come from somewhere. There are those who believe, what do they call themselves? The sovereign citizens that claim that I am not a part of your country. You can't tax me. You can't pull me over. You can't do anything. There are people that say no amount of taxes is right. I think all of us say, hey, society benefits from stoplights and police officers and schools and things of that sort, and there's an amount to be paid for it. The reality is, and the things that people like Newsom don't understand is the number isn't whatever the idiots in Sacramento think they should have to burn on, billion-dollar homelessness programs that don't help any homeless people, schools that don't educate kids. So it's just that balance of saying private industry can do better than what the government can, even if private industry is flawed. So I don't know. Property taxes are there for a reason. All taxes can be debated as to what they should be and where.
Sure. Victor says, my wife and I are trying to start the home buying process sometime in the spring. Should we look for a loan broker first or a real estate agent? So this is something that comes up all the time. In fact, a lot of you from the show, a lot of you from YouTube, just in general, reach out to me because I'm the face on this channel, for one, depending on where you're watching, but also even through different channels, Instagram and some other places, and they want to talk to me about buying a house. And one of the first questions I always ask is, have you been pre-approved? Like, where do you sit in the financing? All of that. And typically, if the answer is no, my very next response is, that's step number one. That is the most important piece of the puzzle, because a real estate agent, I could do my job once I know you're approved. I know your price point, all of that good stuff. Until we get there, we don't know anything, right? We don't know what price range to search in. We don't know how much you're comfortable paying per month. We know very little. You might know what you want in a home, but it's very difficult to find that home if we don't have a price point in mind, right? So starting with a lender is usually the best step. In fact, if you go to that link at the bottom, jebsmith.net/start, you can get in touch with Josh, the team, go through that process. But you can also reach out to an agent, right? Most agents are going to refer you to someone. And here's the thing. I'm going to shock you. We're likely going to refer you to somebody that we work with. And it's not because I make
not some random
Josh doing your loan. I am comfortable with Josh doing your loan. I'm comfortable with Josh telling me, hey, Victor's pre-approved. He's solid. Or, hey, Victor's good to go. There's a couple of issues here because of these things, but I got him cleared up with an underwriter. I've talked to him. He's solid up to this price. I'm comfortable with that. What I'm not comfortable with is calling somebody on the phone and they say, yeah, I pre-approved Victor, or I talked to Victor. And then you just have that, I've been doing this long enough that when somebody's bullshitting you. And I will tell you 9 times out of 10, I'm right. Even if we say, you know what, they said they're pre-approved, we go along with it, there's always an issue. There's always an issue when you think it up front. So just go through the process, work with somebody reputable. But back to the question, a lender is a good place to start.
Jim, let's go back. Ruben had another good question. It actually came before the one that we already answered. And I'm going back and putting the one up that you already answered. It says, I'm having a hard time with lenders charging a lot of points. I found one today only charging $3,000 versus $10,000 and $14,000 from other lenders. And it's that $700,000 home in Marietta. And there is a simple answer. It's because they are chicken shit. They don't want to tell you what the par rate is. They all can offer it to you, but they're afraid that you're going to do what a listener to the show did this week and send over an estimate to me after we've talked and said, hey, I just got these numbers that are significantly better than yours. Can you get more competitive? And we look at it and I said, you're actually paying $11,000 more for the same loan. Did you want to pay $11,000 more to get a quarter lower interest rate? And a lot of lenders, that's the approach that they take. And this starts with online lenders like Rocket, Veterans United. They want to put a wonderful rate on their website. So when you click on it, you go, that's a good rate. I'll apply with these guys. And they'll kick the can down the line. I'm calling a listener tomorrow, Jeb, that she's pre-approved with one of those 2 lenders. And they said, we can't tell you an interest rate yet because you don't have a property under contract. So just keep giving us your stuff. I listened to a training call from a lender last year, one of the wholesale lenders that we give loans to. And they said, you got to realize this is the way the game is played. Your customers are going to go out and they're going to see these really low interest rates. If you're not quoting a couple points, you're going to lose deals because consumers don't know any better. They just want the lowest interest rate. So from that, we always start our quotes with 0 points because the vast majority of my clients, probably 65% of them, many of you here from the show, are first-time buyers. First-time buyers don't have money pouring out their ears. So they rarely say, how could I pay you more money up front and have more cash due at closing? This person I'm talking to that we reached out the other day and asked that question It's a VA loan, zero down. So do you think you want to do zero down, but then pay a point or two, 1 or 2% just for an interest rate that is likely to go away when we refinance it 6 months, 12 months, 18, 24 months out of the way? So there's the commercial. You're in Marietta. We always start our quotes with 0 points. So give me a call. We'll run through the numbers and then we'll compare that to what the paying points to get the lower rate looks like. And you can make an educated decision as to what makes the most sense for you and your family.
All right, good stuff. That link at the bottom will get you in touch with Josh. So John made a statement here, or I'll also ask a question, but I think the statement is where I really find the value in this. One builder company in Houston has an incentive for a new construction of 3.99% interest rate. But there's more, Josh. The property tax is 3.15%. That's nuts. Says, is it worth it? How much would a homestead exemption lower it? Probably very little. I don't know what the homesteads in Texas do, but here in California, it's negligible. I mean, it means very little. So I don't know what that does in Texas, but definitely something to research. Talk to your agent; they should be able to guide you through that. But I can't say whether it's worth it to buy a house with a 3.15%. Property tax or not. But what I would say is don't get caught up in what the builder is offering and get sucked into a higher tax rate, right? Buy the property because it's the right property in the right location and you love everything else about it. And, maybe you would consider another house in that same area and see what the property taxes are there. Is it just that community that's 3.15% because of Melrose or whatever fees and bonds and they have in order to build it? Or is that just the general area that you're looking at? You need to compare apples to apples because, that 3.15, guess what? It doesn't go away and it's going to continue to increase over time. So it's not a fixed rate. Property taxes typically go up. So just know, as it becomes more expensive, your monthly payment's also going to become more expensive. But it's something that you have to be able to answer for yourself. You can't really give guidance on whether that makes sense or not.
And I want to double down on something that you said, just to be super clear on it. The 3.15 doesn't matter. If you were in California and they said 3.15, you're like, oh my God, that's horrific. But many places in California or in Texas are 2.2, 2.4, 2.5. So it's the premium that you're paying relative to other options that you would be willing to live in. It's real money. I would be very careful because, like Jeb said, the homestead's not going to make that big of a difference.
There you go. Nicole is asking to walk us through a 5 or 8 year ARM rate. They seem to be a lower interest rate. Are the fees higher? So Josh, adjustable rate mortgages, 15-year fixed mortgage, 30-year fixed mortgage. Do any of them, do the fees change with the mortgage itself? And then how does an adjustable rate work?
This sort of relates back to what we just mentioned to Ruben about 0 point options, right? So we always start our quotes with 0 points. If I quote you a 7-year ARM and a 30-year fixed with 0 points today, those rates are going to be very similar. If you're willing to pay a point and a half, that 7-year is going to go much, much lower. And people go, why? I thought a point gets me 0.25% lower in interest rate. Well, that's true for fixed rates that are likely to be on the books for 7, 8, 10, 15, 20 years. When a lender looks at this and say, hey, why would someone take out a hybrid ARM? It's because they are not planning on being there long term. They're not planning on paying us a bunch of interest over the long haul. So most of the time, they're wanting to get funds upfront. I have 2 clients right now that are doing a 7/6 ARM. Neither of those are 0 points, but they're at least 0.5% lower on that than they would be on the 30-year fixed. So paying roughly 0.5 point to get 0.5% lower in interest rate. The recoup on that is like a year. You just have to go through the numbers and your mileage is going to vary and it changes over time. When the yield curve, which is a concept we're not going to go into today, but when it flattens or steepens, they can become more or less desirable. So you just have to run through the numbers and see what's out there. Most people, when they look at it, it's not really what it was all cracked up to be. Both of the ones that I'm doing right now are jumbo loans, and generally the ARMs are more attractive in the jumbo space.
All right, good stuff. There was a question here, Josh, earlier about an interest rate. Oh, here it is here. Have you guys heard of OCMBC Inc. from Orange County? I assume that's some sort of bank, Orange County something bank. They offered 6.87 with a credit of $400. Well, understand, Arnold, today interest rates are 6.5%, depending on what you're doing, credit score, down payment, that sort of thing. Potentially with credits as well. So, Josh, any thoughts on this other than reaching out, having a conversation?
Reach out and have a conversation. The number on its surface, 6.875 on a conventional loan, especially if it's an FHA loan, is high. Credit of $400 is pretty minimal. And I just say a couple of things. We get a lot. There's a subset of people in general that are shoppers, and I'm going to shop and I'm going to get the lowest price. What I can say is the people that reach out from the show that have got themselves into the biggest pickles are the ones that I called 14 lenders, and this guy was the lowest, and he was super nice and told me he was going to do this and he was going to drop by cookies after we close. And you get into process and it's a mess. We show you the numbers at the top of the show every week to give you an idea of what's reasonable. We talk about this all the time. Reputable lenders should be in a very narrow range, probably 1/8% from high to low in interest rates, $1,000 plus or minus in terms of fees. So if you have someone that's exceptionally above that, hey, throw them out. That doesn't make sense. No one, the greatest loan officer in the world, whoever he, she may be, is not worth paying 0.5% higher interest rate or $10,000 more in fees. On the flip side, no one has access to magic money. So if someone's telling you they're 3/8 lower than the 5 other people you talk to, the 2 other people you talk to, they are not. So again, what we default to is you want a competitive rate and terms, and you want someone that's an expert that guides you through the process to make sure you are in the right loan program with the right loan structure, and that you are going to go through this completely stress-free because they've educated you and they keep in communication with you all the way through that process. And strangely, the only thing people want to latch onto is, how about this rate? How about these fees? So those rate and fees don't look that great, but there could be more to the story. So use the link in the description.
All right, good stuff. And to follow it up, Dixon, don't know who Dixon is, Josh, but he's giving you kudos here. Just says, you're absolutely right. I went through about 10 lenders, but it was honestly a waste of time. I'm glad I got connected to you. So thanks for saying that, Dixon. Good stuff. Arnold, I think the same Arnold in LA County, offered $75,000 below the asking price, which got accepted, plus a $20,000 in closing costs and $5,000 in repair costs. Home is fully remodeled with a converted garage to an ADU, 2022, modern pool, landscape, etc. What price point is that, Arnold? Just curious for my own wonderings there. What price point that is? What city is it in as well in LA? Interested in hearing, but reach out. Josh can have a conversation and guide you through that.
And just circling back, so Ruben had followed up and mentioned, hey, I just got outbid on a $700,000 home yesterday. I'm on the hunt again. I offered asking price. I thought this was a buyer's market. Don't look at anything nationwide and say you're in a buyer's market. You're in Murrieta. Like, Jeb, would you consider Murrieta a buyer's market right now?
No, I consider it a balanced market, right? I mean, there's definitely some
neutral
opportunities where buyers probably have a little bit of an upper hand, but there's also, sellers also equally have an upper hand on some of those price points. So I understand that everybody in Orange County that's priced out, guess where they go? That area,
Murrieta,
right?
Elsinore.
Yeah, they're headed east, south, whatever. I mean, however, southeast, northeast. I don't even know where the hell it is in relation to here, to be completely honest. It's east, but that's the thing is, so you always have people that are priced out of Orange County, and so that demand moves to other markets.
And it goes back, Jeb, to what we talked about a little bit ago. Where are you on the bell curve? If you're south of median for that area, it's going to be competitive. We have a buyer in LA County. She identified 2 properties this weekend. She's like, one was $699, one was $695. And she's like, I like them. They're clean. My agent's telling me, hey, they're listed low. They're going to go above list. So we're going to offer $700 and be prepared to go as high as $730. One of them, they didn't even get a counter. They had multiple offers above $750. And the other one, they just got a counter offer, a multiple counter offer back at $775. And that's bonkers. I mean, Jeb, would you agree that they were probably underpriced to begin with? It was probably a strategy. The agents knew they had a nice property that if they priced it low, they would get even more offers and probably be able to get a little bit of an auction and push it high. But again, she's south of median for the area. Those were nice, clean homes. Updated, nice, clean, and they go at a premium unless you're in a really, really soft market.
Agreed. Yeah. I mean, what I found is I helped a client in LA. What I found in my career is most of the time, Orange County, I think what I felt, at least again, this is just me outside experience looking in. I feel like most agents try to price it about where it's worth, right? Occasionally you get an agent pricing it super low to try to drive up the price. It's not very common. LA, almost every agent does the whole price, at least every deal that we came across. And we made offers with probably 5 or 6 different agents before we actually got one accepted. And it was a similar situation, underpriced, multiple offers, ended up paying more, but every single deal was priced at. And it was very frustrating from a buyer's perspective and even an agent's perspective, looking at it going, okay, it's underpriced. This is where I see comps. And then not even then, not even that, but just the back and forth, and different markets do things differently. And it's important to find an agent in the market that you're trying to buy in, that is familiar with it and can guide you through that process. Really. The only reason I was even helping in LA was because these were longtime clients of mine and they wanted me to do it. And I was like, I can easily refer you to somebody up there. And they were like, no, Jeb, I want you to do it. And I did it. And, but in all reality, it's good to have an agent in the market that you're in.
It reminded Jeb of the college days when the ladies would say, Jeb, I want you to take me out. There's many men can take you out. I said, no, Jeb, I want you to take me out Saturday night.
You were there?
I was there. I was looking over your shoulder.
You were were you the devil or the angel?
Both. Do it. Do it, Jeb. Do it.
Platinum Black says, what's the median in Orange County now? I think median price point today, if I remember that correctly, Josh, in that newsletter, was just over like 1150, somewhere in that ballpark. Somewhere between 1.1 and 1.2, somewhere in that neighborhood.
Which is a lot of money.
And property was in Chatsworth for anybody that was interested in just finishing the story there, closing the loop on Arnold and the purchase. But congrats, Arnold.
He also shared some details that are interesting or kind of important. $1,025,000 purchase price with 21% down. And you may be watching at home going, 21, what the hell's 21% down? 806,500 loan amount keeps you at the conforming balance. You pay a higher rate for a high balance loan. So LA County, you can go up to $1.2 million and change, but keeping it at 806,500 will give you the best interest rate.
All right, good stuff. Quick question for those of you listening. Not a lot of questions at the moment. Many of you guys know there's another channel outside of this on YouTube, the podcast, The Educated Home Buyer. For you on The Educated Home Buyer watching right now, there's also my channel, Jeb Smith. Josh and I are always trying to think of topics, and me, even myself, of things that you guys actually want to hear, you want to understand, you want to learn. And after doing this for 5 years, I feel like I've talked about everything. I don't know that there's anything new that I can't talk about, but is there anything you guys want clarity on, or anything you want broken down in more detail? Because it's gives us things that, we know you want to hear, gives us things to talk about. And honestly, it's about educating and guiding. And if we can give you what you want, I mean, at the end of the day, that's really the goal here. So if there are things you want covered, put them in the chat. Curious to know. Because that's the stuff we want to film. Ben, what do you see for home prices in the future for the city of Long Beach? So Long Beach is stable. A lot of people, again, priced out of Orange County, head to Long Beach. Long Beach is close enough to Orange County, close enough to the freeways, great neighborhoods, different parts of Long Beach. And so, yeah, listen, I don't see it going anywhere. I mean, I think if anything, it's probably a lot like where we are right here. Prices move sideways to up, probably 2 to 3% appreciation would be my guess over the next 12 months or so, unless interest rates come down significantly, which I don't expect. But if interest rates come down to what we're thinking or just move sideways, I think that's probably realistic.
I want it for a million reasons. I want this experiment to play out. I would love to see rates drop to 5%. And I want to see how many sellers that brings out, and if it would attract enough pent-up selling demand to keep prices flat to stable. The last thing we need is rates to go down to 5% and home prices to go up 10, 15, 20%.
I don't think that happens.
So I want the experiment to play out. I want affordability to improve and to open up some inventory. But there are scenarios where it could work out poorly.
Agreed. Dixieland says that he enjoys the Monday morning podcast, which is the Educated Home Buyer show. That's a 20 to 30-minute breakdown of a topic, usually in much more detail than I do on my channel. But it's, that's where we're really trying to break down the education piece of the puzzle. So if there's something you guys want in more detail, make sure you drop it so we can chat about it.
Jeb, with a follow-up. Good thing I'm retired. I also look forward to your Sunday show.
It's okay.
Jeb.
It's okay. Jeb's channel right now is suffering in views and subscribers, and Jeb's tenacity to push through and do something creative on that channel. 5 years, guys. I'm burnt out. I'm a little washed up now. I have more gray hair, more wrinkles, and quite frankly, I've been saying the exact same things for 5 years, and here we are.
Tell Jeb if he wore sunscreen and moisturized, he wouldn't have as many wrinkles. I mean, we wouldn't moisturize that.
What I was going to say probably would have gotten me canceled. So it's
Yes.
good thing I remembered I was on the air.
They can probably guess what you said. They can see what's in your heart, Jeb.
If you think you know what I was going to say, no, don't put it in the comments. I don't even want that in there. But anyway, good stuff. All right. Do you think 30-year fixed rates will hit lower 5 to 5.5% range? What is your outlook in the Denver area? So interest rates don't change by area, just clarity. Interest rates are nationwide. So what they are in California is what they are in North Carolina, for that matter, unless you're at a local bank, and then, things can be differently, but Fannie, Freddie, that sort of stuff is pretty much the same. 5 to 5.5%. I think there's a chance for that in 2026, maybe late 2026, if the economy craps the bed. If the economy stays strong, I don't think that's really a possibility at this point in the future, for the foreseeable future.
It is a distinct possibility, even in the near term, Q4, Q1 of next year. Is it a probability? Is it likely? It is unlikely. The more important thing when someone's asking a question like this, it's generally because I don't want to buy until it gets to 5.5%, or I'm going to refi when it gets to 5.5%. I'm not going to refinance my 7.5% rate until it gets all the way to 5.5%. I think the lesson from last fall that hopefully everyone took is when you get an opportunity to roll down your interest rate at little to no cost, and it has an appreciable difference in your monthly payment, $150, $250, $400 a month, depending on your price point, how big your loan is, you need to do it. We're doing a bunch of refis right now, and most of these people are moving from low 7s to mid 6s, and we're doing them low to no cost so that if we get to 5.875, they can do it again. And if it rolls to 5 1/8, they can do it again without costing them a bunch of money. A lot of these people they bought a year ago. They're doing 29-year terms so that they're not starting back over at zero. So those are the things that I would look at. It's possible, and it's possible sooner than most people think.
It's definitely possible,
but it's not probable.
Yeah, exactly. I mean, it will happen at some point. Just it's when. And Josh, I think the economy I'm going to put my forecast out, Josh, my 5-year forecast. 5 years I'm giving you. 5 years, it's 100-year, it's a century of the Great Depression, which was the late 20s, right? 29 into 30. That's when shit hits the fan. We're going 100-year cycle. We're going to build up until 28-ish, somewhere in there. And then it's going to all hit the fan. And that's when it all breaks loose. That's when you're going to be able to get your house cheaper, guys. So you're going to have to wait 5 years.
I don't believe in zodiac signals. I don't believe in biorhythm. I don't believe in Ouija boards. So Jeb and your cycles and all the silliness can go take a flying leap.
All right. Well, we'll talk in 5 years. We're going to put this in
We'll be here. We'll have the conversation right here.
I swear to God, listen, if I'm still here in 5 years, something went tragically wrong. I love everybody here, but I don't want to be here in 5 years.
Where are you going? What are you going to do?
I want to be somewhere else. How's that? Somewhere else.
Doing what?
anything.
I'm assuming that
anything
you're going
else.
to need to be earning an income in 5
Anything
years.
else, Josh. I want to be doing anything else in 5
All right,
years.
I'll
I'm gonna
be
have a
here
different
alone.
YouTube channel.
In 5 years, I will be here alone unless I start my golf cart channel, and then that's a different thing.
Oh boy, here we go. Josh has been going to YouTube for the last 4 years, and Josh is still going to YouTube. So we're gonna if I leave, he will. We'll see. Hey, if
We'll
I
be
should
here.
leave, give me a 1 in the chat.
Just
Everybody, give me if you want
if you
me
would
to
like
leave.
if you would like me to self-terminate, put
Yes.
1 in the comments.
Yes, and Josh is referring to Jeb. So a 1 in the comments. Jeb done, and Josh is on this road by himself. I'll even show up on Wednesday nights and heckle him a little bit in the chat.
You don't need to, Jeb. We've got you right here. I will sit here every week and say, "Hey, it's me and Jeb." So then over there on the screen, you'll be right here next to me.
Dude, that guy looks so young. That
less
was me.
Wrinkles, less gray hair, all of that.
Oh man, the good old days.
This was before Jeb's 40th birthday.
I know. That was 5 years ago. God,
you
what
age
happened?
in dog years.
What happened? Jeez. All right. Let's see. All right, we're just going through some comments here. Make sure we didn't miss
one
anything.
thing. Kim needs a soft credit pull. Kim, call me. Call me tomorrow. Thursdays are usually better. It's going to be a little busy tomorrow, but definitely give me a call. You got the number.
All right, good stuff. I think that's it, guys. So this last week we recorded an episode on Vantage Score, right? A lot of you guys have asked about Vantage Score. We had Tony Hutchinson on from Vantage Score, talking about it rolling out, talking about the benefits. If you haven't checked it out, go over to the Educated Home Buyer and check it out. It's a good episode. I think out of all the guests we've had, Josh, probably in the top 2 would be my and I'm not saying that because it's our channel. I learned a lot, and it was a good conversation.
Tony was really good. I did an interview with the data geeks at Vantage Score like 3 years ago when they were pushing to try and get the FHFA to approve them. And it was very educational, but they weren't nearly as well spoken and entertaining as Tony.
There you go. All right, guys, until next week. Adios.
Amigos.